Hey everyone, happy Monday. It's Monday, February 27th. Today on the Final Bar, we will talk about this market opening higher, trading lower through the course of the day. The S&P finishing below 4,000. The Dow just narrowly remaining in the positive. Where are the big moves in the important stocks? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit is designed to help you understand the markets by focusing on the message of price. Price tells you a lot about a lot when you're thinking about investable options, thinking about stocks and ETFs. Can tell you a great deal about supply versus demand, fear versus greed, optimism versus pessimism. John Murphy taught me and many of us years ago, the way that you can make sense of the markets is by focusing on what price can tell us about all the other things going on, right? Well, you can follow the economy and follow the news and all of that. Let's focus on the price. Today, we're going to dig into the price of a number of different assets. We're going to focus a little bit on equity indexes, thinking about large cap versus mid cap versus small cap, mega cap, the Nasdaq versus the S&P and all those different movements. Also some sector themes with consumer discretionary at the top of the list today. Let's get right into our market recap. As I mentioned, Friday, of course, was the end of a pretty painful week for stocks last week. Overall, another negative week for the S&P, but on Friday sort of had this slow and steady gain through the course of the day. Today, we opened up on Monday morning higher. We opened up right around 4,000 and traded a little bit to the upside. So the first 30 minutes of trading, it looked like, wow, lights out. This might be a big up day if we continue this pace. That ended up being it. Through the remainder of the day, we actually went lower, finished below the open, but still above yesterday's close, but not by much. So the S&P finishing just above 3980. The Nasdaq Composite was up about 0.6%, so a little better. And the Dow was just teasing the zero line, but bounced just above it. So finishing the day up about 0.25%. Now, the VIX has come down today. So the VIX has remained above 20 here through the course of last week for the most part. Back down a little bit, still just below 21. So still, I would sort of loosely label that as elevated volatility. VIX below 20, it would be sort of a lower volatility environment, one we haven't seen much of in a couple of years now, but could certainly be the case. Looking at some other asset classes, interest rates were a big part of the story, if not the story last week. And you saw rates start to push higher. And as that was happening, growth stocks like the FANG names all starting to falter a little bit. Today, a bit of a mean reversion to parts of that thesis for sure, with interest rates coming off essentially across the board. 10-year yield down to 392. Friday, we were up around 395, so coming back a little bit. Long bond yields, short-term yields, all down as well. The dollar index down at the same time. So when you think about what's allowing stocks to be higher, particularly growth-oriented benchmarks, it's a weaker dollar and lower interest rates or stronger bonds. That's sort of allowing the benchmarks to go a little bit higher today. Gold actually finishing the green as well. One of the few areas of the market we're seeing some decent strength here. Also, the rest of the commodity complex sort of mixed, right? You have energy components like U.S. oil, USO. The U.S. oil ETF down a little bit, about 1.3%. Silver prices down as well, but other areas like copper and gold and the broader commodity ETF in the green. Cryptocurrencies, for the most part, pretty much in the red. You saw Bitcoin spiking higher earlier in this day, but coming down a little bit. Currently around 23,300. Ether around 1620. Let's look at a chart of the S&P 500 and think about what this daily chart is telling us about the market conditions. Now, my lines are getting busier and busier, and I certainly apologize for that. But this is what I found is when the market gets a little more, when I have more question marks, I tend to get busier with my annotations because I'm trying to get a read on things. So I'm always updating lines and moving things around and just seeing what sort of makes sense. I don't know if this is the perfect place for this line, but I just wanted to move it over a little bit. When we talked about the rally off of the October low, and then December, we had the brief pullback. You connect those 2 points, and that lines up pretty close to where we're at right now here in late February. Of course, February finishing up tomorrow. Now, February is a pretty weak month for stocks overall, unless we have some completely, 5 standard deviation type of move tomorrow, rallying up to 4,200, which I would describe as virtually impossible. Chances are February is a down month after January being, one of the stronger starts to the year we've seen in quite some time. So you've had sort of a strong market off of the December low and now a fairly weak market. And now we're testing trendline support, moving average support, and so forth. When I'm looking at a daily chart of the S&P 500, there are a number of things that are sort of confluences right around this current level. The 200-day moving average is around 39.40. That was actually Friday's low, almost exactly at that point. So on Friday, we traded down to the 200-day, but didn't get a tick below it. We bounced right back higher. Today, moving a little bit higher as well. You also have some of these trend lines. The blue trend line is using the closing prices, and the red trend line is using the intraday lows. And I think you can make an argument for either one of those. I actually would probably just use the intraday lows on here to keep it simple, but I just want to show that this is one of those times when the angles are actually very different because of the weird day we had at the low in October. We had that huge gap down, but then closed way higher through the course of that day. Talk about a classic bottoming pattern. That was one of the most, I think, clear-cut bullish engulfing patterns I may have ever seen. This is as the momentum was giving a great bullish momentum divergence, the RSI making a higher low as the price was making a lower low in October. But back to where we're at now. So we're right at moving average support. We're right at trend line support. The RSI is just above 40. And if you remember what happened back here in December, price sort of having a decent pullback, rotating higher, the RSI, stalling out right around 40. That's pretty classic for a bull market phase where you have big moves higher, often becoming overbought when you rally. And then the pullbacks, the RSI stops around 40, which means if this is sort of that garden variety buyable pullback, the next, downswing before the next big impulse move higher, which is possible, I wouldn't expect the RSI to get much lower below where we were at on Friday, right? Which means if we start drifting lower, we start breaking that RSI 40 level, we start breaking moving average support, all of a sudden the character of this chart looks very, very different. I think we're right at that key point. We happen to be at a point where we have plenty of potential catalysts. There's still a good amount of earnings coming through this week. It's a number of big box retailers, a lot of consumer names, and others that are reporting this week. Just to finish off with what we saw today in our market recap, the consumer discretionary sector, definitely the top performer, followed by industrials and technology. Consumer discretionary, the XOY was up 1.2%, technology up 0.5%. On the downside, you have some defensive areas in the market like utilities, healthcare, and consumer staples. Those are the only 3 that were actually down on the day. So generally speaking, just looking at the sector leadership and laggardship, kind of a classic risk on feel to the tape today with the consumer, technology, industrial type of sectors at the top, utilities, staples, which are 2 of the probably most defensive sectors out of the 11, kind of at the bottom of the list. Now, I wanted to just look briefly, if we could, at the equity market indexes. We talked about the S&P sort of testing moving average support. It's actually back just below its 50-day, testing its 200-day moving average. When you're thinking about different indexes or different groups of stocks or ETFs and where they're at relative to a group of moving averages, the candle glance feature can be a really beautiful way of sort of illustrating that. Because what we can see now, I'm looking at all of these different indexes, and I'm looking at the 50 and 200-day moving average, going back for the last 12 months, just to show, and again, just to focus on where we're at relative to those key levels of support. Here we see the S&P 500 testing the 200-day from above. We talked about that on Friday, how we literally touched it on Friday's intraday low. Here's the Nasdaq Composite. You can see it's almost in a similar sort of configuration. Now, a little bit different because the contours of this chart are a little bit different. What's interesting about a chart of the Nasdaq Composite is if you look right here, we're going to take the swing highs from November and December. So a little different, right? On the Nasdaq Composite, you made this low in October. We really just literally retested the low at the end of December. So while the S&P made a higher low, the Nasdaq was actually threatening a new 52-week low at that same time. It did do so on a closing basis. But then, of course, we rotated back above the 200-day moving average, back above the November and December highs. And now we're retesting those from above. So just like the S&P is testing its 200-day, the Nasdaq Composite's actually testing a support level that used to be a resistance level from the fourth quarter. We're also testing both of those moving averages as well. So same thing. I think you're seeing the Nasdaq Composite also at a pretty meaningful support level, confluence of support, if you will, to pay attention to. The NYSE Composite is actually testing its 50-day moving average. So if you look back here in December, as the S&P was making a higher low, the Nasdaq or the NYSE Composite was testing a 50-day moving average, an ascending 50-day, tested that but rotated higher. Over the last week, the NYSE Composite has actually gone below the 50-day moving average, which is not a great look, right? And the reason why I'm saying that, generally speaking, in a bullish phase, you'll see things pull back to a 50-day moving average or a 10-week moving average. Those things start to not hold support. That can be an area of concern. So I think with the S&P and the Nasdaq Composite, you have some clear moving averages to look at. Trend lines in the case of the S&P. For the NYSE Composite, can we regain the 50-day moving average and just get back to more of a bullish configuration? Open question. And again, the RSI is right at 40 there as well. So I think all these benchmarks have pulled back to some key levels. Let's see if they're able to hold them going into the remainder of this week into next. Just wanted to finish off looking at a couple other breadth indicators if we could. We highlighted this last week. As of today's close, still less than 50% of the S&P above their 50-day moving average, around 48%. For me, the bull case for stocks would be this indicator going back to the upside. You don't want to spend too much time below the 50% level, because if you do, it starts to look a lot more like a deeper and more protracted contractive phase as opposed to, or corrective phase, as opposed to a brief pullback before the uptrend is resumed. So again, sort of right at that key moment. Now, long-term, there's still 60% of the S&P above their 200 days. So that's still actually pretty firmly in the bullish category. Again, we start to break the 200-day. A lot of those indicators can change very, very quickly. Just to finish off, the last thing I would point you to is looking at offense over defense. And what I like to do for that is look at the relative performance of consumer discretionary versus consumer staples. Now, January, when you think about how bullish January was in terms of risk assets going higher, look at how these ratios came off of a new low in December on the cap-weighted version and just accelerated to the upside in January. Negative month for the most part in February. Same thing on the equal-weighted basis. Super strong in January. Weaker in February. For me, the bull case for stocks involves these ratios certainly turning higher, because the longer we go with staples outperforming discretionary, which is what it means when the ratio is going down, that means investors are getting more defensive than offensive. That's not how a sustained rally in stocks is most likely going to play out. Let's take a quick commercial break. We'll be back answering some of your questions from the Final Bar Mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to be back here live on Monday and every weekday after the close for our show. A couple quick announcements before we bring on the Final Bar Mailbag. First off, our mailbag is fueled from questions from people like you. Shoot us an email with any questions you're running into as you are analyzing the markets using technical analysis and behavioral concepts. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we are on YouTube. Subscribe to our YouTube channel, won't you? And also put a comment below the video you're watching. We'll hope to answer you live on the air on Friday's show. Wanted to let you know about the upcoming guests. We have some really cool guests coming up this week. Tomorrow, on Tuesday, the 28th, I have Chris Verone, who's the head of technical research at Strategas Research Partners. I've known Chris and followed his work for many, many years. He has a wide following in the institutional community. We'll see what charts he is talking about when we talk to him tomorrow. On Wednesday, March 1st, very excited to talk to Adrian Zdunchik. Adrian is the founder of the Bird Nest. He is a noted cryptocurrency expert, has built up a fantastic community following the cryptocurrency markets using technical analysis. We'll see what he thinks about cryptos on Wednesday. On Thursday, we have Mary Ellen McGonigal from Simpler Trading coming back on our show. Also, next Wednesday, the 8th, we have our next episode of The Pitch. We have three fantastic panelists, Mary Ellen McGonigal, Mish Schneider, and Aaron Swenlin, three women technical analysts who are probably well known to each of you because they are a common presence on StockCharts TV for very good reason. You go to StockCharts.com/thepitch for more info on that upcoming episode, and make sure you tune in live on Wednesday, March 8th. I want to continue on with our next segment, the Final Bar Mailbag. Keep the great questions coming, and let's get to question number one. Dave, how do you differentiate a pennant from a flag? And is your ARK bullish thesis still intact? You sent this after last week. We were talking about the ARK Innovation Fund, and actually sent this chart, which I'll bring up. And I appreciate you sending your chart. I had posted a chart, talked about it on the show, posted on social media, and my line looked a little different because the time I sent it off, it went like this, right? I was sort of highlighting, it was right around here. And I was highlighting this potential bull pennant, right? Which is when you have a rally and then you have a pullback and then you sort of, have lower highs, higher lows. And the question is, which way do we resolve that pattern? What's interesting is since I sent that around and since we talked about it on the show, the pattern's evolved a little bit. And this is I would say one of the challenges of pattern recognition and pattern analysis is that patterns are not set in stone, right? Something can change even during the course of a trading day and the subsequent days. Once you put a pattern into place, the pattern can evolve because the movement in the markets is fluid. Now, all of a sudden, it looks more like a bull flag, or probably I'd call it a wedge pattern, which is when you have a rally and then you have more of a parallel decline. This one, it depends on how you draw it, but I would probably draw it more like this. And all of a sudden, it's looking, I think you could describe it probably as a wedge, which is when you have these two lines that are going to converge at some point, but they're both kind of sloping downwards. That would be called a falling wedge. Again, what's interesting is the analysis is kind of the same, right? You're waiting to see which way this pattern breaks. And as we talked about on the show, either of those patterns, a pennant, a wedge, or even a flag pattern, most of the time complete to the upside. And that's why they're considered continuation patterns. This is usually the break after a big move higher. You have sort of this consolidative phase, and then you resume the uptrend. So what this tells me is that the ARK Innovation Fund at best is neutral. If and when it breaks above the upper trend line, which has remained static since we talked about it, then it's at best neutral, and at worst getting worse because we're sort of undercutting the previous lows. We really break below this trend line. There's not much more we can do to define it as anything other than a failed breakout and a lower high, and now resumption of the downtrend, which is why all of those patterns, they're not really triggered. They're not a confirmed pattern until you break out to the upside. And I guess that's my final point on there. Anything like this we talk about, is it a pennant, is it a flag? All of those things are question marks until you complete the pattern. You only complete that pattern when you actually break out of it. And that's not happened yet, certainly to the upside, which would be the normal expected movement on a chart like that. Thanks for that question. And I would agree, it's no longer a pennant pattern. It has to be labeled as something else. Next question. There are a lot of talks of mentioning dumb money versus smart money. Are there any indicators or tickers for, quote, dumb money and, quote, smart money? And those labels have been around for quite some time. We probably should come up with some more probably positive ways of describing these different practitioners. But this is the general way that in the markets, we've talked about sort of the retail investors and the institutional investors. The idea, again, from years and years ago, decades ago, when these concepts were first sort of, I think, championed, was the idea that institutional investors truly had a lot more institutional knowledge. They had a lot more often insider information from companies about what to expect. A lot of that has now, of course, gone away, if not all of it. Most of it certainly has. And I know that there, that the idea that the quote unquote smart money has access to additional information a lot less common than you used to hear it. I would say this is in some ways the golden age for individual investors and financial advisors in terms of the access to information and analytics and analysis. At Fidelity, the chart room 50 years ago was a novelty because most people didn't have a team of analysts that could be updating charts by hand. Now, of course, you can access, really capable charts on platforms like StockCharts.com. So are there any indicators or tickers to follow? There are a couple that I would mention to you. The one that comes to mind, particularly when you're talking about, the quote unquote dumb money. And again, for lack of a better way to describe that, I would say one of the sentiment indicators we've talked about before is the AAII survey. That's the American Association of Individual Investors. This is a weekly survey of pretty much all retail investors, mostly kind of later on, probably retired. My average guess would be this is someone who is retired, managing their retirement accounts of some sort. That respond to the survey for the most part. It's a total generalization. But this is a weekly survey. Are you bullish, bearish, or neutral on stocks? So if you want to get a direct read from market participants in that cohort telling you what they think is happening, that's one way to do it. The other thing we could do is look at positioning data, right? So then the RIDEX flows, which is this series in red at the bottom. This is literally looking at fund family data from the RIDEX funds and seeing where investors are positioned. And are you rotating, or are they rotating more to offensive things like long only type of funds and sector funds, or more defensive things like cash and money market types of bets. And by looking at that, you can actually see where investors are allocated. Now, if you want to get a sense more of the smart money, more of the institutional investors, little less transparent, of course, but two things I would tell you. Number one, you could look at survey data. So something like the name exposure index is actually more money managers. These could be wealth managers managing, in some cases, a pretty decent book of business, all the way up to larger money managers that respond to that survey, that talk about how they're positioned in the equity space. But to be honest with you, an analysis of price and volume, I would argue you're primarily looking at the smart money, right? And getting a sense of when you see some of those signs of exhaustion, some of those signs of divergences. The early adopters are sort of the smart money, the people, contrarian investors that are, willing and able to take aggressive bets on mean reversion. I think in a lot of ways, that's sort of what you're looking at when you describe the smart money. Those are a couple ideas of what to do. And I would say, again, those are all estimates and assumptions, make a ton of assumptions about what they're really reflecting. At the end of the day, those are more anecdotal ways of describing, is it big institutions driving things, in which case big volume would be probably one of the best indicators of that. Next question. You mentioned a non-confirmation of the Dow Industrials and the Dow Transports as an early indication of consolidation. Were there any others that you noticed? And that's a really good question. The chart in particular, I think you're talking about, because we mentioned it recently, was looking at the Dow Theory, which I have in another chart list. That would be here. I have what's called the traditional Dow Theory, which would be this one, where you look at the Dow Industrials and the Dow Transports. And I also do what's called the new Dow Theory, which is looking at the S&P 500 and the Nasdaq Composite. And I really prefer that, all else being equal, as a modern way in 2023 of addressing sort of the two main pillars of the economy, what I would call the old economy and the new economy. But what's interesting is on the February peak, as the S&P is making a new swing high, or attempting to, as the Dow Industrials are failing to do so, transports blowing out to the upside and making a new swing high, this was a really notable divergence, or what we call a non-confirmation, where one of the two is breaking out and the other one is not. And I think that was one of the things to see in mid-February, that the uptrend that we'd seen in January may really be starting to falter out a little bit. What else would I maybe look at? I mean, another one that I would probably say, going back to our Mindful Investor Live chart list, I would say two other things that maybe come to mind. The first would be that measure of offense over defense, which would be this one. What's interesting about this one is, if you think about what the markets did in January, rotating higher, you think about February, instead of going to a further high and thinking about further upside for stocks, the ratio of offense versus defense, or consumer discretionary versus consumer staples, the highest point it's been now in 2023 was basically the first or second trading day in February. From then, it's actually been going lower, which for me, the moment that stops going higher, as it had, all of a sudden it starts to feel like a very different market, particularly in the short term. The other thing I would use to answer that question would be measures of breadth, to be honest with you. And I would say indicators like the McClellan oscillator, like the bullish percent index, those have been probably two of the best sort of non-confirmation or more contrarian sell signals that we saw in January. So the downward slope that we saw in the McClellan oscillator, as the S&P was making a new high for the move for the cycle into late January, the McClellan oscillator was sloping downwards. The same with the bullish percent index that had been above 70 but came down. That all happened right at the beginning of February. Those two things, I think, were the most important indicators in my toolkit that suggested that the run we had in January was probably at or near an end. And for now, I think they're at sort of a question mark phase, because they both come down but have not really shown any signs of improvement from where they've been from those that downswing. Final question, then, where I have to wrap the show. For candlestick analysis on stock charts, what color settings should one use in chart attributes for the classic charts, the black, hollow, and filled candles? So what's really cool about the StockCharts platform is we kind of give you all the settings right up front. So what I would tell you is two things. Number one, if you ever see me look at show a chart on here, or if there's a friend of yours, or if you see an author or something, if you can get a look at the settings down here, if you can take the chart and save it to a chart list that you have. So if it's on like a shared chart list or on my Mindful Investor Live chart list, once you save it, you can see all the settings that we use to set up the charts. And I will tell you the quick way, if you want to know, is under where we say chart styles. You're going to have any chart styles that you've created. You can see there's a bunch of ones that I've either created or people like Gaddis, Grayson Rose, Greg Schnell, Larry Tentarelli, others have sent me, Tom Bowley have sent me some of their chart styles, and I've saved them because I thought they were pretty good. If you go down here to SCC default, this is kind of the default chart that probably looks familiar right when you set up your login. This is what all your charts will look like until you start creating your own chart styles. And I would encourage you to do that. Make the system your own. Make your your account much more fine-tuned for how you're trying to analyze the markets. But when I'm looking at a chart like this, these are the settings right below. And the important things would be make sure your type is set to candlesticks. Make sure your color scheme says default. Up and down color is set to auto. And if you do that, for the most part, your chart's going to look really, really similar to this. And these are the indicators at the bottom. So if you hit pause on the video or rewind it or something, you can see the exact settings that we use on our default setup on StockCharts.com. We have to wrap the show, folks, and go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. Looking at the S&P 500, we talked in our market recap about the S&P, the Nasdaq, the New York Composite pulling back to potential areas of support. And I have sort of found my general process means I have a sense of what I see as the primary trend for my time frame. At this point, I would say the primary trend is up because of the strength we've seen over the last 3 to 4 months. However, and I would say part of that means when we have pullbacks, I would assume those pullbacks to probably hold. But at some point, I have a line in the sand that tells me this is not a pullback that is holding. This is the beginning of something a little deeper and more painful. And the way that you can tell that is instead of pulling back to support, we break through support. Instead of going down to a trend line, we break through the trend line. Now, if you look on a closing basis, the S&P 500 is still above trendline support. We're also still above the 200-day moving average on a closing basis. As long as those things are still the way I would describe the S&P, things are not getting that bad. But I also like to look at the advanced decline lines. For the New York Stock Exchange advanced decline line, we're still in great shape. For the mid cap and the small cap AD lines, we're all very much firmly in the bullish framework. The large cap advanced decline line, no. And it's actually already broken down through trendline support and broken below its 50-day moving average. So the first check on the not so bullish column, I think, has been made because the large cap breadth that I would look at is starting to turn negative. The rest of these still positive. And again, the bearish case for stocks would mean one by one, these start to break moving averages and trendline support. It has not happened yet. Chart number 2, Dish Network. Dish is down today about 8%. That's not the point of this chart. The point of this chart is when people see a stock down a lot, I'll get a lot of questions on, is this the time to buy? And when I ask and sort of dig into what is it that's so attractive, what I find is it basically comes down to the fact that the stock is down a lot. And I will tell you, down a lot is not a great justification for anything because I was taught price usually goes down for a reason. Look at all the times over the last 12 months when Dish made a new 52-week low. It happened a bunch of times. As a matter of fact, almost once a month for a lot of this chart, you can see we're making a new 52-week low. So today's new 52-week low is just the latest of a bunch of new swing lows that we've seen. So when a chart is in a clear downtrend, to me, that's a clear message to look for brighter places, greener pastures somewhere else, and don't just buy something just because it's down a lot. So if that's not where you're looking for opportunities, where do we find opportunities? For me, it's areas of the market like industrials, like materials, charts that have been strong that have pulled back a little bit. When I was scanning for names that fit that criteria this morning, Steel Dynamics, STLD, came up on my list. This is up about 2.5% today. Not a bad move and outperforming the S&P, but that's not what's most exciting to me. It's the fact that we're above 2 upward sloping moving averages and the relative strength is going up. In general, if I own a bunch of charts where the relative strength line is going up, I'm feeling pretty good. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the final bar. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night. guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.